Welcome to Business Middle East. This week, we discuss quantitative easing programs by some of the world's most powerful central banks. Japan shocked the financial world with the announcement of plans to pump even bigger amounts of cash into the economy through further QE. The ECB is also looking at additional stimulus measures, perhaps including QE, to ward off the specter of deflation in the euro area. These actions risk starting currency wars, but this, in fact, could benefit the Middle East.
Stimulus through quantitative easing is a radical monetary policy intended to boost economies where there is little or no growth. Fearful that its efforts to revive growth are stalling, the Japanese central bank has decided to increase its purchases of government bonds by a quarter and triple the amount it injects directly into the Tokyo stock market. The announcement sent share prices soaring in Tokyo and gave them a bump in China, even though economists warned the move could trigger a currency war, particularly in Asia. That's where countries initiate policies that cause their currencies to fall in value, making the goods they export cheaper and giving them a trade advantage. As Japan is the world's third largest economy with huge car making and electronics industries, that's a significant factor. The Eurozone, where growth is sluggish and deflation threatening, now has to decide if it needs to go down the quantitative easing path and when. Last week, European Central Bank President Mario Draghi would only say they are preparing further measures to be implemented if needed. This is all happening just after the Federal Reserve ended its QE programme, having decided the US economy is recovering sufficiently that it no longer needs that stimulus.
To analyze the situation, we are joined as usual by Al-Hammoury, Chief Market Strategist with ADS Securities in Abu Dhabi. So first, Noor, as you know from the American experience, it seems the quantitative easing does work. Is it that simple?
Well, of course it is not that simple. Basically, the QE or the cheap money policies, it had some of its positive impact on some sectors, and at the same time, there are even a lot of talks that the situation right now is even worse than before. The QE, it did pop up the asset prices and even benefited the stock market. However, it did not help the real economy. So for now, as we saw in Japan, more and more money continue to come in. However, this is going to be a positive impact on the short term, but not on the longer term, because you have these balance sheets from the central banks are expanding and reaching a record level. So it's almost impossible to unwind these balance sheets without damaging even the global market and even the stock market.
If there is a currency war and the Japanese yen weakens further, what effect could that have on economies and stock markets around the world, especially in the Middle East?
Well, globally first, the QE, of course, that we have seen from Bank of Japan, it pumped all the equities across the globe. We've seen the Nikkei 225 increased more than 10% in a few days after the announcement of the QE. This kind of a situation where all the central banks are trying to weaken their currency. So this would be, at least for the Middle East, it's going to be positive. And we've seen the positive impact from these cheap money policies also from the Bank of Japan across the globe, even in the Middle East. However, the Middle East impact will be limited in terms of the stock market, but at the same time, you have the importers will be benefiting from weakening yen, where they can bring also more and more import from Japan, but with lower prices.
Thank you, Noor, for joining us.
Thank you for having me.
That's all for this edition of Business Middle East. Join us on the Euronews Business YouTube channel. Thank you for watching. See you next week.